Did you know that a middle-class man in America typically loses up to 40% of his net worth within the first 24 months of a divorce? And no, it's not just the lawyer's fees. There is an invisible tax being drained from your bank account every single day while you sleep. Most people think that if they earned $100,000 as a couple, they'll simply live on $50,000 as a single. It sounds logical, it sounds fair, but it is a mathematical lie. By the time the dust settles, those $50,000 will feel like $30,000. If you feel like you're drowning, even though you have a decent salary, you aren't losing your mind. You're just experiencing the divorce math. Stick with me until the end, because I'm going to show you a specific number that will force you to rethink your entire budget for the next year. Let's talk about the single tax. In the US, our entire economy is built for couples. When you were married, you had one roof, one heating bill, one high-speed internet plan, and one Costco membership. Now, you're trying to run two separate households on the same pool of money. A one-bedroom apartment in a safe neighborhood doesn't cost half of what a three-bedroom house costs. In most states, it's 80% of the price. Your utilities don't drop by half just because one person left the room. The trash still needs to be picked up, the lights still need to be on. You've lost the economy of scale, and it's costing you an extra $15,000 to $20,000 a year just to exist. But the real disaster isn't happening at the grocery store. It's happening in your tax return. Meet your new most demanding partner, the IRS. For years, you likely filed as married filing jointly. That is a massive legal cheat code. The standard deduction for 2024 is nearly $30,000. The moment you switch to single, that deduction is cut in half. Your tax brackets shift. Suddenly, more of your hard-earned money is being taxed at 22 or 24% instead of 12. You are literally paying a premium for being alone. And here is the kicker. If you are the one paying child support, remember this: that money is paid with post-tax dollars. You pay the government their share first, and then you pay your ex. You are being taxed on money you don't even get to keep. There's a common phrase in family court: 50-50 custody. You might think that means 50-50 expenses. It almost never does. You still need a bedroom for your kids that sits empty half the week. You still need a second set of toys, a second car seat, and a second pantry full of snacks. In America, the hidden costs of fatherhood after divorce are staggering. You're essentially paying for a full-time family home while only living in it part-time. It is a massive drain on your cash flow that no one warns you about during the mediation phase. You aren't just building a new life, you're building a duplicate infrastructure. Now, let's address the elephant in the room: the house. Many men fight tooth and nail to keep the family home, often out of guilt or for the sake of the kids. This is usually the single biggest financial mistake you can make. Why? Because a house is a liability that eats cash. Property taxes don't care if you're divorced. Maintenance doesn't care that your income just dropped. If your mortgage, insurance, and taxes take up more than 40% of your new take-home pay, that house is no longer a home. It's a sinking ship. I've seen men with six-figure salaries end up at food banks because they refused to sell a house they could no longer afford. Don't let your ego bankrupt your future. Beyond the monthly bills, there is the erosion of your future. The QDRO, or Qualified Domestic Relations Order. This is the legal tool that splits your 401k or IRA. It's not just the money you lose today, it's the compounded growth you lose over the next 20 years. A $50,000 hit to your retirement account at age 40 is actually a $250,000 hit by the time you stop working. Most men try to catch up by taking on more risk or working more hours, leading to burnout. But there is a better way. It starts with radical honesty and a rule I call the 70% strategy. Here is the formula for survival. You must learn to live as if you earn 70% of your actual income. If your paycheck says $5,000 a month, your brain must believe it says $3,500. That 30% gap is your divorce buffer. It covers the taxes, the unexpected kid expenses, and the rebuilding of your emergency fund. It's not easy, and it's not glamorous. It might mean driving a used car or skipping the expensive vacations for a few years. But it is the only way to ensure that 3 years from now, you are standing on solid ground, while others are still drowning in debt. In our next video, we're going to dive deep into the house trap. I'll show you the exact math of when to keep it and when to walk away, featuring a case study of a man who saved his house but lost his life savings. This channel is your quiet harbor. No drama, no politics. Just the math of getting your life back. Hit subscribe and let's start rebuilding. You've got this.